Hey guys, Dave Keller here with Market Misbehavior. We're now recording this in early May 2022. And when it comes to this month, I often get asked about what's called the sell in May and go away phenomenon. Today we'll talk about what that means. We'll look at some brief market history and look at the conditions now in May 2022. So, should we sell in May? So the market is full of market maxims, the financial industry, things like sell in May and go away. If Santa Claus should fail to call, bears may come to Broaden Wall. That's a little, I had to think about that one. I hasn't talked about that one in a while. But also a lot of the seasonal tendencies, things like the Santa Claus rally, the January effect, some of the traditional cyclical or seasonal patterns that we see over the course of 12 months and in regularity in market history. What we're talking about today is what's called sell in May and go away, and it's pretty well documented that if you break the calendar year into two halves, you have the first half is sort of May through November, or May through October. The other one is November through April, and you look at the two of those 6-month periods. Going back over deep market history, that November through April period by far outperforms May through October. And so this is now starting in May is considered the seasonally weaker half of the year. It becomes more of the stronger half of the year in November. And what we're going to do in today's video is look at the seasonal trends in the S&P 500. Actually look at what the data tells us. Look at the chart of the S&P 500 back to the 2009 low and talk about why this phenomenon has been a little more challenging in recent history. Then we'll just briefly look at today's market conditions and see how it relates to these seasonal trends. Before we get to the charts, if you like the sort of thinking about investor decision making and behavior, I hope you'll subscribe to my channel. Also give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below. Do you agree that sell in May and go away may play out in 2022, or do you think the opposite, and why? Let me know in the comments below. Let's look at the chart. All right, so here on StockCharts, we're using what's called the seasonality chart. And if you're not familiar with it, up at the top of our page, you go to seasonality, type in the ticker, and it'll show you the basically monthly returns on average going back through some time period that you would select at the bottom. And it'll show you all the different observations that comprise these. And you can look at what's called a spaghetti chart if you want to stack them all together. But this is basically a histogram showing you the average returns over those months going back through history. And also the height of the bars tells you the batting average, or basically what percent of the time that the particular ticker that you put in finishes the month higher than how it opened. Now, if you look back, and we're looking at the last 20 years of data, you can see why the sell in May phenomenon sort of makes sense looking at these return profiles. Going back just over the last 20 years, which is only getting us back to sort of the 2002 market low, you can see that from that period on, the strongest month of the year has been April, followed by November. So when we talk about the seasonally strongest parts of the year, the reason is because the market often bottoms out in September and October. And these are things like, the flash crash and what else? The 1987 crash, Black Monday, that's in October. And so if you look back in market history, a lot of market bottoms had occurred in the beginning of the fourth quarter in sort of September, October. November actually tends to be a stronger month because it's usually coming off of the lows that we've set at the end of the year. People are pretty happy going into the holidays. January actually tends to be pretty weak, particularly in the last 20 years. I don't think that's the case if you go further back, but I'm just looking at 20 days for today's purposes. And then finally, you can see that the market tends to do better and better into April, which tends to be a very strong month. Certainly did not play out in 2022, but on average, pretty decent. And if you look at the average returns, you can see it as the strongest average returns of the 12 months going back to 2020. So this middle part of the year is what we're talking about. And basically, it's the May through October time period. So if you look back over the last 20 years, it's played out this way. If you go back into deeper history, it further, I think, even accentuates this data set and shows you how the market often bottoms out sort of September, October, and the other 6 months starting in November tends to be the strongest. So that's why it became a market maxim. That's why we talk about it. Let's look at what's happened just in the last couple of years since the March 2020 low. So here's where the market actually bottomed out. There's the S&P low around 2,200. We then went higher. May starts here. So if you bought on April 30th, or if you sold on April 30th and then waited until October 30th to buy back, you probably wouldn't have enjoyed that 6 months out of the market. That was sort of the meat of this big move higher. Now, then let's go to the next year, right? So in 2021, which was last year, sell in May would have been right around here. The S&P's at 4,200. At the end of October, which is here, the S&P's around 4,600. So pretty painful gain to be missing out on. So in recent years, sell in May has not actually done very well. But what's also interesting is November through April has also been pretty strong as well. And that's the nature of this market environment that we've been in, what's called a secular bull market, right? If you bought on October 30th and sold it on April 30th, you would have made a pretty decent gain here. Now, for the moment, November through May has been actually pretty painful. So the seasonally strongest part of the year, November through April, has actually been down this year. In the previous, in the time before that, the May through October phase in 2021 was pretty strong. So it just in the last year, selling in May, you'd want to actually do the opposite. You want to buy in May and sell in November. Here's the thing, right? That concept that May through October tends to be weaker has not really played out since the 2009 market low. And the issue with sell in May, and the reason why it's not a very convincing strategy for a lot of newer investors, is they've rarely seen it actually play out. These orange arrows just very quickly show you the returns every month, going back to the 2009 low, where you basically bought at the end of April. On April 30th, you sold on October 30th. Basically what would your return experience have been? So in that seasonally weakest part of the year, sort of the spring, summer into early fall months, have overall been positive, right? So strong in 2009 coming out of the 2009 low, sort of a sideways, unchanged. Now, granted, you had a big dip, but you made it all back by the end of October. 11 was a down year. 12 was higher, 13 higher, 14 higher, 15 flat, and then we see higher. So for the last, 8-9 years, it's been either flat to positive. So even at times when the other half of the year has been strong, the problem is the seasonally weaker part of the years have overall been fairly powerful. And so that's why it's been tough to digest recently. However, again, if you go back to the long history, you realize how unusual this run from 2009 up to this potential top here in early 2022, how rare that of a nice, clean stretch of uptrend that the market has been experiencing. So if the seasonal tendencies say sell in May, but the recent history tells us that sell in May has actually not been very profitable, what are we doing now in 2022? This is where I would argue that while seasonal tendencies and calendar patterns can be interesting for anecdotal evidence, you really want to focus on the price behavior, because that tells you, regardless of what the market should be doing based on a rhythm or a regular cycle, here's what the market actually is doing. And here's one chart that I've covered on this channel and a lot of other things, looking at price and breadth and sentiment, why I would declare pretty clearly that the market's in a clean distribution phase or a bearish phase. One of the charts I'd share with you today, just to sort of reinforce that, is what I call the new Dow theory. Now, Charles Dow, over 100 years ago, championed this idea of looking at the Dow Industrials and then the Dow Railroad Index. So the producers of goods and the distributors of goods, are they in agreement? So if the Dow Industrials and transports are both breaking up, that's a confirmed uptrend. If they're both breaking down through support, that's a Dow theory downtrend confirmed by the different parts of the economy, essentially. The problem is the industrials in 2022 aren't really traditional industrial companies, and transports are a bunch of airlines and other things. It's not, it doesn't include things like Amazon and Walmart, Target, that have, sort of their own distribution channels that they may use. So what I do is I would do what's called a new Dow theory. Look at the S&P 500 and the NASDAQ composite, sort of the old economy and the new economy. Are both of these, indexes breaking higher, which you saw in November of last year? That's a confirmed uptrend. When you see one of them making new highs and it not being confirmed in the other one, like you saw with the S&P making a new high in January and the NASDAQ making a new swing low in a lower high into January, suggests there was a non-confirmation, right? Instead of confirming the breakout, they're not. Look at what's happening right now. In the last week, both the S&P 500 and the NASDAQ have clearly broken below, on a closing basis, their lows from March. So the S&P breaking now below support at 4,200. The NASDAQ composite below 12,500, we'll call it. So as these indexes go downwards, that tells you, despite any seasonal tendencies in recent history or in deep history, the trend remains down. What would tell you something is potentially changing? One of those indexes makes a higher low. It could happen soon, but it's not happening here in May so far. So that is a breakdown of the seasonal tendencies and this idea of sell in May and go away. We talked about how the recent history doesn't really play out that way. May through October has actually been a fairly profitable part of market history over the last 12, 13 plus years. But it's important to remember that despite those tendencies, despite what the short-term evidence tells us or the long-term thread of market history may indicate, at the end of the day, it's all about the trends. And both the S&P and the Nasdaq breaking to new lows for the year here in mid-May. That suggests a market in distribution. You wait to see when one of those does not confirm a new low. I hope this helped you understand the sell in May phenomenon. If you have questions, put it in the comments below. Also, do you agree with that? Do you think that this market is in full distribution mode? Maybe May through October is going to be a lot more pain before further gain? Let me know in the comments below. For Market Misbehavior, I'm Dave Keller. Take care. Have a good night.